Hi, and welcome to Trading with TK, teaching you to turn ideas into money. We're at www.tradingwithtk.com, and this is our weekend question and answer period where I try to answer some questions that were sent in to me by some of my readers. So let's get started. The first question comes in from James. James writes, can you talk about the difference between being a specialist with a seat on the New York Stock Exchange versus being a trader working from your computer at home? Do you feel being on the floor gave you a sizable edge over trading from home? Are there any advantages to trading away from the floor, far removed from the thick of things? James, this answer is twofold. There's two answers, yes and no. First, I'm going to address the question from when I was on the floor, prior to the exchange going public, prior to this what they call hybrid market, because things have changed dramatically. So first let's talk about when I was on the floor of the exchange so you can understand the difference. Huge advantage the specialist had. Just a privileged position that he was in. He got to see 90-95% of all the order flow that came through the stock that he was specializing in either went through his hands or was standing in front of him with a broker handling the order. So he got to see every buyer and every seller. He may not have traded against them, he may not have actually executed the order himself, but he saw it. Also, the broker in the crowd also got to see the same thing. So this was the advantage of being on the floor. You actually got to see, I won't call it inside information, because it's not really information coming from the company or fundamental developments, but it is inside information from the point of view of you actually got to see how many sellers and how many buyers were standing in the crowd at any one given time. Not only that, he was dealing with face-to-face brokers, and he could read their emotion. Let's say he was negotiating with a seller, and they were trying to put a bid together for a guy who wanted to sell 50,000 shares, and let's say they decided on a price down 3/8 of a dollar. By the time you saw it on the tape at home, you might have said, gee, I would have, if I knew it was going to trade there, I might have bought some stock there. But this is the advantage that the guys on the floor had, because they are the ones that were in the middle of the negotiations. By the time you saw the final decision, it was on the tape already. So this was the privileged spot that the specialist was in. And, he was trading in eighths back then, too, so it was 12.5 cents. Big difference from what it is today. It's only a penny today, the spread. So the answer to the question is, was there a big advantage? Yes, and that's why seats were trading at $1 million and well over $1 million. In order to get that privilege, you had to pay for it. So there was a cost to it. But yes, specialists had a huge advantage over any of the other upstairs traders. Now let's move fast forward, because the answer today is no. There's no real advantage. The game has changed dramatically to the point where the specialist no longer gets 90-95% of the order flow. He's lucky if he gets 35%. Where's all the other order flow going? There are competing ECNs. All the orders are delivered to the specialist book. Yes, there's still a specialist, and he still has a book, but it's nothing more than an ECN. And all orders get delivered to him electronically. No more brokers walking in with 100,000 shares for sale, and you could read his face and you knew he had a gigantic order. There are no faces to the order today. It's all a game of numbers. They don't see any more than you see. They do still control the opening. They still know if there's a buy imbalance, and they control the close, although the close is usually a pair off. But from what I understand, even the opening is going to change, because they're eventually going to be told that they have to display the order imbalance at the opening. So you're going to get to see everything he sees. Not only that, on top of that, we no longer trade in eighths. They're trading in pennies. So all these changes that have come about since the exchange went public have a huge disadvantage to the specialist. And I guess the advantage now has been spread over more of a level playing field to everybody. Whether you're upstairs on a desk or if you're home trading. His cost of capital, he still has to maintain the same amount of money to trade these stocks. His obligations haven't changed, but his profit margins have changed just dramatically. To give you an idea of the scope of change, okay, there are 1,368 seats originally. I think there are 1,366 now that the exchange controls, and that you lease for about 40 or 50 grand a year, and only 700 of all those seats are actually being utilized. There used to be 3,500 people on the floor, clerks and members. There's probably down to about 1,200. The pay packages have dropped from, let's say, 10 years ago. Top guy in a firm might be making $1 million to $2 million a year. They're lucky if they're making $250. So the specialist business is not the profit center it used to be at all. And there's probably more changes coming down the road for them. They just can't seem to, they don't have the edge anymore. So the answer to the question is yes and no. Yes, it used to be. No, it's not anymore. And I think it's important that my readers understand how dramatic of a change there has been on the floor, and how much competition the specialist now has. And I think it bodes, better for the independent trader like you and I. So I hope that answers your question, and it's an important question. Okay, my next question comes in from Lee. Lee writes, you have been around during the difficult markets, such as 73 and 74, bear market, which was also linked to oil problems, where things looked just like that difficult. So my question is, do you see any relations regarding this bear market and previous ones? Or, as many like to say, is it different this time? Well, it's always different, but they're always the same. First, let me qualify the fact that I don't like to put names on bull and bear markets because it locks you into a mindset that you can't change readily. So let's just call them big downtrends, long drawn-out downtrends. However you want to look at it, the direction of the market's what's important, okay? And we are in a major downtrend from what I see so far. I've been taught that some of these major downtrends that I've lived through, 73, 74, can last about 18 months to 2 years. That's like the Chinese torture type of downtrend. Or you can have an 87 type of downtrend that lasts a matter of months, dramatic in price, but it's over quickly. Both go down about the same. It's just the length of time that's different. Also, what's different each time is the groups that go down. This time, oil is not going down so much, but other stocks are going down. The banking industry is in such bad shape, okay? Which leads me to believe that you think that, most people think that this whole problem is stemming from the oil, and I'm not from that school. Yes, oil is probably a 25-pound weight on the market, on top of the 100-pound weight that was already there, put in there by the banking industry. The banking industry overlent. They lent to people they shouldn't have lent to. This is the same problem that causes these downtrends every time. You can go back to 1929. It's always the same problem. Over lending, over borrowing. Money that can't be paid back. And this is what causes these big downtrends. And now the banks have gotten themselves in so much trouble that whether they have money to lend or not, they're not lending it. They've made so many mistakes that they're afraid to go back in and start lending money. What they're trying to do is they're spending all their time trying to raise capital themselves to get their balance sheets back in business, that no one's lending money anymore. Even if the money is there, they're not lending it. Interest rates, immaterial, because I don't care what the interest rates are, the banks aren't lending money. So the market becomes a source of capital for the small guy and the big guy. You need money, you sell stocks. You sell your 401k to save your house. You sell this because you need the money. You're in debt. And that's why the selling is going on. Selling happens not so much because price-earnings ratios are too high or the earnings don't look so good. This is not an earnings-driven sell-off. This is a sell-off because I need the money. And that's my view of this sell-off. Yes, oil is a factor, but I don't think it's the key factor because the banks have started down over a year and a half ago, and the handwriting was on the wall back then. If you've been an astute reader of the market for years, you know that the banking industry is a key element in reading the market. So until the banks straighten themselves out, I just don't see a bottom here yet. So as long as we're on the right side of the market, we'll be okay. So I hope that answers your question. I hope I was able to teach you something this weekend, and I look forward to talking to you again on Monday. So till then, this is TK signing